This is going to be one of the most important economic videos you have seen in a long time. Be sure to watch it till the end. You don't want to miss any of this. It's going to give you a massive edge and let you figure out when the recession is most likely to come to help you plan. Like I said, you do not want to miss this. Darius Dale is on Wealthion today, and he has some charts that are absolutely amazing. I want to go over these with you. We're going to watch it together, and I'm going to give my thoughts and takes on what he's saying and try to explain what he's saying too, because it is absolutely fascinating. So let's dive in. Be sure to hit that subscribe button.
This problem from a little bit of a different timing problem set. So if I can share my screen here, one of the so I updated our monthly macro scouting report presentation in preparation for this meeting. So every month we put out this presentation for our client base. It's usually about 100 slides. It kind of covers our modal outcome views.
What it's really going to do is it's going to help us see when the recession is coming based on data. So it's a very strong forecast based on data, not gut feeling, not tinglies. This data he's about to share, do not go anywhere. Watch this entire video. You have to. If you miss this, you are doing yourself a big disservice. This data that he's going to go through here is going to give us a likely time frame for when the recession is going to happen. Is that valuable to know? Yes, it is.
Kind of expounds upon what we think are the left tail risks and the right tail risks to those modal outcome views. And with respect to some of the left tail risk views, we'll walk through, and I won't spend too much time on this, but we have a variety of different indicators that we use to sort of identify where we are in the business cycle. I think Kentrich's hope framework is extremely instructive. It sort of gives you a kind of efficient nowcast of where we are. What we're trying to do is actually forecast where we are so we can actually make these pivots in our portfolios on a proactive basis rather than a reactive basis.
Based on data.
Which is being reactive, but certainly I think adding a little bit more foresight might be somewhat helpful. So I'll start.
I think Michael would agree with that comparison too. I love that. His is more of a nowcast.
Don't go anywhere. You do not want to miss this.
Totally. And again, phenomenal framework. As someone who builds quantitative models for a living, I'm a big fan of his hope framework. I just wanted to expound upon it with some of the tools that we use with our clients. So I'll start with the inversion of the 3-month 10-year Treasury yield curve. We're at minus 162 basis points inverted. When we sequence this particular indicator relative to, real GDP cycles, industrial production, payrolls, unemployment, core PCE, what we're trying to do is identify what the interval is that has the highest probability of observing a GDP
interval. Right? This is the data he's using, historical data that goes back about 100 years. This is what he's using to forecast the interval. How long from when we see these events happen to when we get a recession. This is how we're able to time the recession. Do not leave this video. Watch all of this.
Contraction or significant uptick in unemployment.
Or you're just shooting yourself in the foot. just watch this.
And what we can find here is that the probability of seeing, both of those outcomes is actually in the kind of 12 to 18 month forward interval, i.e. the probability.
We're just getting started. So he's laying the first groundwork saying about a 12 to 18 month interval from when the 3-month crosses the 10 in terms of treasury bonds, where the 3-month yield becomes higher than the 10-year, and there's more data to come, right? Because one piece of data, you can't use that. But if you can stack a bunch of them together, it gives you a high probability, right? Because we can't work in certainties. We can only work in probabilities. And the more we can find the higher probabilities based on historical, factual data, the better we set ourselves up to win. You want to win, right? So let's go. I'll talk less, but I just want to make sure that you understand all this because it is math, and not math. It's data, and that can kind of make some people's eyes gloss over. So I want to stop sometimes and let you know, okay, here's what he is saying.
Seeing real GDP contract from the date of the 3-month 10-year inversion, the probability of seeing a significant rise in unemployment rate from the date of the 3-month 10-year yield curve inversion. And so that would suggest, based on the timing of this inversion in October of last year, it would suggest a recession is most likely to commence in the October 2023 to April 2024 period.
So the data triggered in October of 2022, right? So that means that 12 to 18 months for this one piece of data. This one piece of data doesn't tell us exactly, but already he's setting the framework saying somewhere between October of this year to April of next year based on this historical data, which has been very accurate for 100 years. Is showing this time period. All right, that's where we start.
and that's the 12 to 18 month forward
Don't leave
interval
this
from
video.
that inversion. The next model we use is the model that anchors on, kind of where we are in the labor cycle, specifically with respect to continuing claims as a percent of the total labor force. So that's the red line in this chart here. We're at 1.12%. And historically, we've gone all the way up to, I mean, ex-COVID, I had to cut off the chart, but we've gone pretty high in this indicator, in upwards of 5 to 6% in previous recession cycles. And so what we looked at in terms of the same sequencing of events.
Hold on, we got to go back there real quick because I got to point this out to you. Look at this. Look at this. These red bars are all recessionary periods going all the way back to, this one goes back to 1969. Those red bars are all recessionary periods. The blue line is unemployment. Look at where unemployment is before it spikes up. It's always super low, right? We had that period, and now we've had a descending low, right before the red bar, and right at the top of unemployment is the end of the recession, right? Once it breaks and starts coming back down. Look at where we were here. Boom, COVID. Well, it's COVID. Well, I'm not going to get into that. But here we are. We are as low. We are the lowest. We were the lowest we've been in unemployment since 1969, right? And now what he's circling right here is showing this spike in unemployment. Look what happened here. Spike, 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 spike. This is the next piece of data. Don't go anywhere. Do not go anywhere. Well, I already know, you're going to say it's going to start in October, April. I already saw it. No, that's not necessarily what's going to happen here. Wait for the rest of the data so that you can understand, because you need to be informed. You need to have your knowledge base so that you can make the most informed decisions going forward, right? Don't just skim this stuff. This is one of the most important videos, most important compilations of data you are going to see in this period.
Or percent. And historically, we've gone,
Sure,
we've gone all the way up to, I
button.
mean, ex-COVID, I had to cut off the chart, but we've gone pretty high in this indicator, in upwards of 5 to 6% in previous recession cycles. And so what we looked at in terms of the same sequencing of events, what we looked at is the monthly trough in this particular metric, continuing claims as a percent of the total labor force. And right now, the monthly trough was in August of last year, where we're also, again, looking for the interval that has the highest probability of seeing a significant rise in the unemployment rate or a significant rise in the in real GDP contraction, and that would seem to suggest.
So the 3-month crossed the 10-year bond yield in October of 22. So that was one trigger, right? The continuing claims kicked off in August of last year, and so the 3-month cross in the 10-year puts us a forecast of when recession starts between October of this year, 23, to April of 24. And now this data here with the unemployment shows between September of this year to February. See what I'm saying? So we're going to put all these pieces of data together at the end. Rather, he is, and I'm going to do my best to simply explain them. So don't go anywhere.
That on the 6 to 12 month forward basis, that's sort of it. On a 12 to 18 month forward basis, that's kind of it when you factor in the unemployment rate as well. And so that kind of puts you in the September 2023 to February 2024 time period. So that's October 23 to April 2024, September 23 to February 2024. And so that's two, so we're 2 for 2 there.
2 for 2. So we're looking somewhere between September and April. The window has gotten bigger. Let's see if we can narrow it down.
Got a few more models here, and I'll be quicker. This model shows the spread between the Conference Board Consumer Confidence Expectations Index minus the Present Situation Index, and we're at minus 83 in terms of that deep negative spread. Well, as you can see in the chart, these deep inversions at all in this particular indicator tend to coincide, or at least be leading indicators of a red bar, a recession showing.
Look at that. This goes all the way back to 1970, right? Well, 1969 really, because that's where it really starts. Look at when those red bars happen. Look at those. Let me try to get
up in the chart. And so what we're trying to do is
so the red bars here, right? They get down here right before recession, right before recession, right before. Again, the red bars here are recessions. Right before, here's the COVID one. Now we're back down here. It's 100%. It hits 100%.
Identify what's the highest probability interval for a recession to occur. Because again,
I know we're going into recession. No. That's not easy enough. Most people know that. But to understand what it's going to look like and when it's going to happen is what gives you an edge.
It's not just enough to say, okay, we know a recession's coming. If a recession's coming 2 years from now, you could lose out on 35, 40% upside returns in something like the S&P.
See?
What we're trying to do is make sure that we're putting on a recession playbook with the appropriate amount of time ahead of a recession so that we are not missing out on upside. We're allowing ourselves to take advantage of beta in the market. And so going back to this analysis, the data, the trough spread actually is currently, the trough spread is the most recent indicator, most recent month. And what we look at, again, looking at, okay, what's the interval that has the highest probability of seeing real GDP contract, unemployment rise, and that's the 6 to 12 month forward interval. So again, that puts you in the October 23 to March 2024 period.
So now we're still sitting in September of this year to April of next year, somewhere in that window.
We also look at this through the lens of coincident and leading economic indicators, specifically the spread between coincident and leading economic indicators. And this is, as you can see in the chart data goes all the way back to the 1960s. Is one of the deepest inversions we've ever seen. Now, we can get into a whole tangent on, okay, why is this thing so low? So some people seem to believe that, hey, there's so much going on from with respect to the leading indicator basket, i.e. the U.S. economy is not as tethered to the manufacturing sector as it once was, certainly, as it was going back to, to these earlier time periods. Holding that aside. Yeah, sorry, go ahead.
No, just saying, it's a different world today than it was in the 50s and 60s from a U.S. manufacturing standpoint.
Absolutely, a totally different road. And actually, I will finish up on this tangent because I don't like to leave the listeners hanging.
Not done yet.
Here. It is a totally different world. This chart here shows the percentage of the manufacturing share of total non-farm payrolls. And this line here, we only have data going back to 2005. It's manufacturing share of nominal GDP. And as you can see, I would assume the red line probably tracks the blue line over time if we have data for it. But we're only at 14% of total non-farm payrolls and 18% of GDP. So very clearly, manufacturing is not this, giant, noose around the neck of the U.S. economy that it probably once was in these previous cycles. And that's part of the reason why we see less red bars, in our opinion. Manufacturing is significantly more volatile than the services sector, and we know this because we sequence, recessions through a variety of different indicators. Now focus your eyes on these two columns. It says manufacturing as a share of non-farm payrolls, so that's the blue line in that previous chart. But this column here is actually more important. It shows manufacturing sector share of the non-farm payroll drawdown during recession. These are each of the recessions that we had going back to Act 1 of the Great Depression. On a median basis, it's 98% of the drawdown in non-farm payrolls. And so there are plenty of instances where manufacturing was, greater than 100%, i.e. the services sector continued to grow despite the contraction in manufacturing. So a lot of times in recession, what you're effectively calling for if you're making a recession call is a deep depression in manufacturing that may or may not spill over into the services sector. I happen to think both are likely to occur in this particular cycle for a few reasons. But getting back to the timing, I think the timing is more important before we explain why. So going back to,
so he's saying that manufacturing is in for and already seeing a massive slowdown, and the question is if it spills over into services, which would be restaurants, plumbers, real estate, like anything people do for other people, not manufacturing, which is making things.
Leading indicator.
But manufacturing is already seeing a big drop, and he's saying it's going to go even bigger. And the question is, how much does it spill over into services? Whew.
There's in coincident economic indicators, this inversion. When we look at the inversion, the data that inversion was June of 2022. We're looking for the interval that has the highest probability of seeing a real GDP contraction from the date of that inversion, going back to each of those previous cycles. And that's the 12 to 18 month forward interval. That puts you sometime in the second half of 2023. And then lastly, in terms of these models, we have
things keep lining up. And this is a very important one to watch too, what he's going to go over right here. But things keep lining up with what? Second half of 23, first half of 24, right? Basically Q4, maybe the second half of Q3 to Q1, maybe first half of Q2, right? So somewhere between halfway through Q3 and halfway through Q2 of 24, halfway through Q3 of this year, 23, through halfway of Q2 in 24. It's not done yet. Now we're getting into a really, really good one here. You don't want to miss this.
Sharp rise in cyclical unemployment. So what I'm showing in this chart is the number of unemployed workers who have just either lost their job from being fired or who've also completed temporary jobs. And what I'm showing in the black dotted lines in this chart from the perspective of respecting the x-axis, that's what we're trying to do here, Adam. I think the number one thing that I preach to our customer, our client base, and ranges from trillion-dollar institutions all the way down to mom and pop retail investors. They all receive the same information from 42 Macro. But the number one thing I think I coach investors on is this concept of respecting the x-axis. Not just saying this is going to happen, therefore I need to put it on. If there's a lot of time and space between the XYZ happening and you putting it on, you're subjecting yourself to a high degree of market risk in both directions, right? Risk works in both directions as always relative to your legacy positions. But going back to these black dotted lines here, what they show is the rise in this particular indicator, cyclical unemployment, a 10% rise on a trailing 3-month basis off the cycle low. And what you see is that, hey, look, it's usually in or just ahead of a recession.
See that? Yeah.
Well, guess what? We got one of these in March of 2023. And so you look at the interval that has the highest probability of seeing real GDP contract or the highest probability of seeing the unemployment rate rise. It is the 0 to 6 month forward interval. And so that puts a recession kind of in April 2023 to September 23. So when you add up all this stuff.
You see that? See, now we're looking at even sooner. But most of the data is pointing us to after summer. But now this one pulls it back even further. You see what's going on here? So all the data that we've looked at so far put the recession between September of this year to April of next year. But now this piece of data, which is the unemployment, which is a massive, massive piece of data, pulls it back all the way till possibly now to September. So now that narrows our window. And this video is not done yet. Don't leave. Hit the subscribe button while you're there. Pulls it back even further, saying, all right, April of next year seems maybe a little too late. So now we're looking at somewhere between, in my opinion, from what we're looking at so far on the data, September to February, right? So March and April of next year seem too far out. So we are looking at the next 9 months. Well, the next 3 to 9 months. That's a pretty narrow window. That's very valuable, but we're not done yet.
The modal outcome suggests a recession is, probably somewhere in the Q4 range with a little bit of spillover to Q3 and a little bit of spillover from a tail perspective back into Q1 of next year. So I think that's kind of like, trying to time this whole situation. We were comfortable making the transitory Goldilocks call back in January.
So that is pretty much the data right there. He goes on for a little bit, but listen. So look at that data. That is the most important. This is one of the most important economic pieces of data and videos you have seen in a long time because I consume this stuff. I study this 12 hours a day, every day. And I'm telling you, what he put together here sums up exactly what we should be expecting. So, second half of Q3, so that's basically September, to the first half of Q1, which is basically February. Do you know how valuable is it to have that info, to have that data to shoot for, meaning that we're probably going to maintain somewhat of a sideways range. None of this is financial advice, ladies and gentlemen. We're working in probabilities, not certainties. I can't guarantee a damn thing. No one can. But we're looking at between now to probably September is going to be more of a sideways range. But after that, it seems quite probable that we will see new lows, right? Stock market cannot go up when unemployment is rising. Well, it can, but not when unemployment starts rising and starts going up into an uncertain period and GDP is going down, right? It can't do that. It does eventually price it in and find a top, an end of it, a bottom rather, but it seems to me like we're going to trade sideways somewhere between, 3,600 and 4,200 for the next several months. And then the shit's going to hit the fan potentially somewhere between September and February. That's what this looks like here. Wow, this was so good. Thank you, Darius Dale. Thank you, Adam Taggart and Wealthion. This was so good. I hope that you got value from this. I hope I was able to dissect this and give you information because this data can be confusing, right? But I study a lot of this stuff and I use it a lot. So being able to try to break it down for most people to understand, that's what this video was all about. So hit that subscribe button if you like more of this stuff and you want more, but hit that notification bell so that you know when I come out with this stuff because it is timely. You want to know when it comes out, okay? Have a good one. Thanks for watching.